So I've got another set of clues for you that maybe it's time for a second opinion. And this one, these are really, really important. The first clue it may be time to get a second opinion on your finances is if you have unusual investment performance. And so what do I mean by that? Well, let's say that the overall stock market, S&P 500, the Dow, whatever major index you want to look at a total market index, whatever it is. If that overall indicator of the market's performance for, say, a given year goes up 10%, and your portfolio goes down 10%, that is probably a pretty good indicator that something is rotten in Denmark. Something is not right. And so I'm not suggesting that your stock-based portfolio, if you have an equity-based portfolio, should be in lockstep like those parade of soldiers you see marching down the street on television. I'm not suggesting that at all. I'm also not going to tell you that a portfolio should always be built to match the stock market or even work exactly the same way. If you have a diversified portfolio that includes bonds, commodities, real estate, all these other things, then it should not move in lockstep. What I'm referring to is if you've got a portfolio that is designed to be a growth portfolio, that is designed to be equity-based, and is intended to be a long-term accumulation vehicle for you, maybe to serve as the funding for a future purchase or expenditure, or to serve as a hedge against inflation, then you should expect a general same direction movement. So if your portfolio goes down 10 while the market's going up 10, that again is probably an indicator that something's not right. Now, what might cause that? Well, there are several things, and I've got a list for you. Number one, the portfolio is poorly diversified. You've got a couple of, say, major holdings, and those individual holdings don't do well. So let's say you've got 4 stocks that represent 70% of the portfolio, and then the rest of the portfolio is made up of maybe some mutual funds. Well, if just one of those stocks does badly, or more than one of them, you could see some serious losses while the market still goes up. Other indicators, it could be that your investment funds in general, maybe you do have a diversified portfolio of funds, but let's say that the advisor doesn't pay attention closely enough, or whatever the case may be, and those funds, they slip in terms of their performance. They no longer are 4 or 5-star rated mutual funds from Morningstar. Maybe they now are 1 and 2-star rated funds. Well, that could be an explanation on why your portfolio is lagging the overall market or even moving in a different direction. And another one that's on my big pet peeve list is high fees. If you are paying 3 or 4% a year or some other high fee amount, then that could definitely drag on your portfolio. Bear in mind that the average mutual fund, if you take all of the mutual funds that are available in the marketplace and you push the average button, the average cost per year, even though you don't see it, is about 1.4% per year. So if your portfolio is costing 3 or 4%, not only what the funds charge, but also the charge from the advisor, then that can really add up and that could drag on your portfolio. So the other thing is, could be if your portfolio is being churned, where there are repeated sales commissions being generated for the broker or his firm or her firm, and that is putting a drag on your portfolio. I've seen that where there have been changes in the portfolio, and I've scratched my head and said, I don't really understand why we're making all these changes. And what we find is it's really the result of the advisor trying to generate commissions. I mean, I just have to call it like it is there. Now, I don't see that often, but when we see it, it can also be a significant drag on the portfolio. Now, so that's the first set of things that could be an indicator, is that your portfolio is lagging or moving in an unexpected direction. Now, the other one, which may surprise you, and I need to explain, is that you have consistently good performance. You say, hey, wait a minute, David, that sounds good to me. I'll take that. Well, before you say yes to that and sign up, be careful what you wish for, because you could end up like Walter. Now, who's Walter? Well, Walter's a made-up name for an actual person that came in to see me a few years back. And Walter came in. He was a couple of years away from his planned retirement date, and wisely, Walter wanted to get a second opinion, a confirmation about his plans for retirement, maybe get a little help on how much he could reasonably withdraw from his accounts, maybe do some repositioning to make his more aggressive portfolio that he had to make it more conservative, to make it more income-oriented as opposed to growth-oriented. The financial industry calls that the accumulation phase, which is when you're putting the money away and as your funds are invested more aggressively. And then we call it the distribution or deaccumulation or depletion or controlled depletion phase on the back end when you're drawing money. Well, so Walter came in, asked me to review what was going on, and he was very proud. His portfolio had done very, very well and had done so consistently. And actually, his average return that he shared with me was about 18% per year. That's unheard of. And so I was very curious to understand how the advisor was achieving these kinds of consistently high returns. His statements weren't really complete. They weren't real clear. He had performance reports that the advisor had provided to him that the advisor had created, but a report from the actual company holding the account, the custodian, wasn't really complete. So I asked him to get back with me, get the statements, let's review it. A couple months went by, didn't hear from him, and then a story broke in the paper that there had been a big scam. You knew it was coming, right? And Walter had been a victim of that scam. There was no 18% returns. His account did not exist or had been depleted. And Walter thought he had $1 million for retirement, and he had nothing for retirement. Horrible, sad, heartbreaking. I don't understand why people do what they do. This person, the advisor, had scammed Walter and other people out of their hard-earned money. Now, the warning sign to you is if you see outsized, just too good to be true performance, it just is unheard of and almost always is associated with a scam. So that is probably as good of a sign as you can get that something is not right. Now, again, follow your instincts, listen to your gut. And when you hear of something like that or you see something like that, I really think you have to be careful. It's just not realistic to expect that type of performance. Now, advisors can make good recommendations. They can position you well, trying to time the market, trying to be a prognosticator of what's going to happen and to position your portfolio. That can occur. Advisors can have expectations about what's going to happen, but to tell you that they can have consistently high returns is just really stretching it. And so a good sign that it's time to get a second opinion so that you can plan stronger.